In September of 2021, India identified rupees 2 trillion worth of bad loans. To recover the same, the government had set up something called as a National Asset Reconstruction Company, or NARC. Now, what does this National Asset Reconstruction Company do? Technically speaking, this NARC is actually a bad bank. It has been created by the government to recover the bad loans. Bad banks? Yes, that's the topic for the day today. Here we discuss what are bad banks, how it works, why are they important, and much more. Hi all, my name is Dheeraj Vaidya from wallstreetmojo.com, the home for most authentic place to learn finance and accounting. Let's get started. First thing first, what is a bad bank? A bad bank is basically a setup to buy bad loans, that is, non-performing assets from other banks and financial institutions. So after procuring these NPAs, they try to recover the amount by using different recovering strategies. This way, the original bank or the financial institution can clear the balance sheets after transferring their assets to the bad bank. So where does the NPA or such toxic assets come from? The way it happens is that the regular banks actually provide loans to the customers by reviewing their credit history, right? Now, as per the terms and conditions of the loan needs to be repaid fully, within the stipulated time frame. This way, the loans provide regular income to the bank so that the banks can function effectively, correct? Now, what happens in some cases is that the loans may not be repaid at all, or let's say the assets may not be able to generate the income that was desired. So this results in two things. One, it lowers the performance of the bank, and it also affects the profitability of the business. Now this is how the non-performing assets or the toxic assets are formed. Now what does the bank do in this case? To combat the issue of non-performing assets and these bad loans, the bank uses the strategy to segregate these poisonous assets from the good ones by selling it to bad banks. Let me explain it to you with a very simple example. Imagine that you want to renovate your house, but you don't know what to do with the already existing stuff that you have, whether to keep it or to remove it. So for this, you'll have to decide first, what you need and what you don't need. You can segregate all the unwanted stuff that you don't need and plan a way to dispose of them, right? You can actually find a dealer to sell off the old furniture, as this frees up space and also provides you with money as well, right? In a bad bank scenario, this is exactly what happens. The actual bank segregates all the toxic and the bad loans from the good ones and sell them to the bad bank. The bad bank procures these non-performing assets and uses specialized strategies to make the most of them. Bad banks provide lots of advantages to the traditional bank. Now think of it like this. Bad banks are a perfect option to free up the capital that is used to cover the bad loans. In addition, successfully resolving bad loans will improve banks' earnings, based on the recovered amount. Now, with such a creation of bad banks, the burden of recovery actually shifts from the traditional bank to the bad banks, right? So the traditional bank can concentrate on their main business. On the other hand, the main focus of bad bank is to recover the non-performing assets. As a result, the speed of recovery is much higher, providing much more benefits to the bank. So how does a bad bank make money out of these bad loans? The NPAs actually are generally bought at a very less price as compared to their original price. However, when you look at the bad bank, they will profit only when they recover such bad loans, right? So all this seems to be very simple, but practically it is very difficult. Given all the factors, especially in the case of economic crisis, it's very difficult to recover. However, in most cases, the bad banks won't take a loan unless they know it is actually possible to resolve it. So think of it like this. Bad banks will not take those critical loans which have a very low probability of recovery. In a nutshell, a bad bank is created only during the economic crisis to combat the issues and recover the banks to their original functional efficiency. They take the bad loans, try to recover them using different strategies, thereby reducing the burden on the actual banks. After all, you need a bad guy to deal with a bad guy. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future video, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on finance and accounting topics regularly. So if you haven't subscribed to our channel yet, then please do so by clicking on the subscribe button below so that you can get the notification about our latest videos as soon as we release one. Thanks for watching. Have a great day.